right now, global markets are looking at a nearly 15% return in emerging markets and just throwing a massive parade.
Yeah, they really are.
But, behind that shiny double-digit headline, the financial system is quietly pricing in the risk of a systemic debt crisis in Africa. And it's doing it based almost entirely on the sales of microchips in South Korea.
Which is wild when you actually stop and think about it.
It is. So, welcome to the deep dive. Today, we are tearing apart a highly contrarian, incredibly urgent financial strategy note. It's titled The Wrong Proxy. And our mission for you today is to unpack this massive structural vulnerability that global capital markets are completely blinding themselves to.
Right, all while hiding behind the very distracting, very lucrative facade of the AI boom.
Exactly. And it's just a brilliant piece of analysis because it challenges the fundamental way we measure risk. Because, if you just look at the surface level data right now, the global market looks like it's in a golden age.
Oh, absolutely. You have U.S. equities hitting record highs in April. You have, 83% of S&P 500 companies beating their profit estimates by an average of 11%.
Yeah, something like that's huge.
And as you mentioned, the MSCI Emerging Markets Index, which let's just call it the EM index today, is up 14.7% year to date.
Which is an incredible run for a sector that has notoriously struggled over the last decade. So on paper, it looks like a broad-based economic miracle. But okay, let's unpack this. If those numbers are so uniformly fantastic, why is this strategy note waving massive red flags? Why is it treating that 14% return like a ticking time bomb?
Well, it all comes down to a concept the author calls disaggregation.
Disaggregate.
Right. And the core thesis is captured in one incredibly sharp sentence from the text. The author says, Korea's chip exports don't pay Ghana's external financing bill.
Oh, wow. That is a phenomenal line because it immediately breaks the illusion of the index, right?
Exactly. The author's arguing that right now, looking at an aggregate average, like the EM index, is fundamentally dangerous because that 14.7% headline number implies that the emerging market sector as a whole is thriving.
Right. Rising tide lifts all boats.
But when you disaggregate that data, when you actually strip it down to the individual country level, you uncover this massive structural fracture.
And the data from Goldman Sachs on this is just wild. When you look at where that return is coming from, Korea and Taiwan accounted for more than 90% of the EM index's earnings per share growth this quarter.
90%.
More than 90%. South Korea's KOSPI index posted its best month since 1998. It jumped 31% in April alone, which was entirely driven by South Korean exports, surging from $20 billion in December 2025 to $30 billion by March 2026.
Which is purely the Asian AI hardware boom. It is a highly localized, highly concentrated capital expenditure cycle, and it's completely distorting the aggregate data.
Let's put a visual on this for everyone listening. Think of the EM index right now, less like a broad market indicator and more like a blended smoothie.
A smoothie. Okay, I like where this is going.
So imagine you throw a huge handful of perfectly ripe sweet strawberries into a blender. That's the AI hardware boom in Asia.
Right.
But then you also toss in a big handful of literally rotting spinach. That's the struggling frontier nations.
Right.
You blend it all up, and the sweetness of the strawberries completely masks the taste of the rotting spinach. You drink it thinking you've got this healthy emerging market smoothie, but it's actually a dangerous concoction.
That's a perfect analogy. The strawberries are subsidizing the spinach on paper. But what's fascinating here is the critical market failure happening because of this. Institutional investors are drinking that smoothie and mispricing the risk of the entire asset class. We see this explicitly in the emerging market debt spread.
And just to ground our listeners really quickly, the EMD spread is essentially the premium that investors demand to take on the risk of emerging market sovereign debt compared to ultra-safe U.S. treasuries. If the spread is wide, investors are scared. If it's tight, they are complacent.
Right. And at the end of 2024, the EMD spread was at 325 basis points.
Okay.
Today. It is compressed down to 243 basis points.
I genuinely struggle to understand this. How can institutional money managers, people who are paid millions of dollars specifically to assess geopolitical risk, look at a 243 basis point spread and not realize they're pricing African sovereign debt based on the revenue of Korean semiconductor plants? Is it willful ignorance?
It's heavily driven by the mechanics of passive flows. I mean, when billions of dollars flow into an emerging market ETF, that capital doesn't discriminate. It buys the index.
Right, it buys the whole smoothie.
Exactly. It compresses yields across the board. The market is looking at the overall health of the EM space, seeing the massive cash generation from Korea and Taiwan, and effectively assigning a lower risk premium to the entire asset class. But as the note points out, a frontier nation doesn't have access to the tax revenue or the hard currency generated by those chip plants.
Which brings us to the reality of those frontier nations, the rotting spinach in our blender. Because while the AI boom is masking the pain on paper, there is a massive geopolitical shock tearing the actual physical emerging market universe in half right now.
Yeah, and Gramercy's May 2nd report highlighted what they called the week's most structurally consequential news for frontier sovereign credit.
Let's get into that.
So, former President Trump explicitly rejected an Iranian peace proposal that would have reopened the Strait of Hormuz, and he did so specifically to avoid delaying nuclear talks. Furthermore, the U.S. military has reportedly briefed the president on plans for a short, powerful wave of renewed strikes.
And obviously, we are just reporting the structural signals contained in the source material here. We aren't taking political sides. But when you introduce that level of war duration risk into the Strait of Hormuz, the market reaction is immediate, and it's violent.
Oh, absolutely. Brent crude oil spiked to an intraday high of $126 per barrel before settling around $108.
That $126 handle is a massive systemic shock. And this is where the divergence in the EM universe becomes incredibly stark. If you are an emerging market that exports energy, you just won the lottery.
Right. Gramercy's data shows Angola's sovereign bonds rallied 2.06% for the week. Venezuela was up 1.41%, Bolivia up 1.39%. I mean, they are generating massive hard currency windfalls.
But if you are on the other side of that trade, like if you have to import your energy, you are facing a sovereign crisis. When crude spikes to 126, your import bills skyrocket overnight.
They blow up entirely.
Yeah. And if your government subsidizes fuel to prevent civil unrest, your fiscal deficit blows out. You just start burning through your foreign exchange reserves just to keep the power grid running.
And the credit markets immediately priced in that pain. Sri Lanka's bonds fell 1.95% on the week. Ukraine dropped 1.65%. Egypt fell 2.12% in local currency terms. We are literally watching the credit universe physically bifurcate based on a nation's energy balance sheet.
So let me push back on the severity of this for a second, though, because I was reading through the BOFA global economics data in the notes, and they highlighted that the effective U.S. tariff rate has actually dropped significantly.
Right, it fell to 8.7% in March.
Exactly, down from a peak of, 11.3% in October 2025? So isn't the consensus on Wall Street that this tariff rollback is a huge tailwind for emerging market exports? Shouldn't that act as a counterbalance to the oil shock?
That is the narrative Wall Street is trying to spin, yeah. But the strategy note aggressively dismantles it. The BOFA data shows that blanket tariffs are not being lifted. Instead, they're being replaced by country-specific tariff exemptions.
Okay, but even if it's country-specific, let's say tariffs drop on Mexican or Vietnamese manufacturing. Doesn't that free up global supply chains, create more trade velocity, and, indirectly help the broader emerging market space?
You would hope for a trickle-down effect, sure. But the math simply doesn't move fast enough to cover a $126 barrel of oil.
Ah.
Those country-specific rollbacks concentrate the economic benefits almost exclusively in proximate manufacturing hubs. Places that already have the infrastructure to export finished goods to the U.S.
Right.
So a frontier nation in sub-Saharan Africa that primarily exports raw agricultural commodities. They get zero benefit from a tariff reduction on assembled electronics in Vietnam. The structural reality is that lower targeted tariffs do not generate the hard currency needed to offset their exploding energy import bills.
That makes a lot of sense. The benefits are localized, but the oil shock is universal. And the note actually uses India to prove just how devastating that universal shock is, because we aren't just talking about tiny, fragile economies here. India is a titan.
Absolutely.
They have $697 billion in foreign exchange reserves, and yet their Nifty 50 index is down 7.95% year-to-date.
India is the perfect stress test for this theory. They are absorbing a brutal compound shock right now. They're highly reliant on energy imports, so the Hormuz closure drains their capital, but they're simultaneously facing forecasts for a weak monsoon season which threatens their domestic agriculture.
Right, the Goldman Sachs warning.
Exactly. Goldman released a specific warning that anytime Brent crude sustains above $100, India's food inflation accelerates to dangerous levels.
So if an economic fortress like India is buckling under the weight of this compound shock, the smaller frontier nations are in deep, deep trouble. Though I do want to bring up one fascinating anomaly from the data that really proves why you have to look beneath the surface. Ghana's corporate bonds actually gained 2.19% this week.
Right, which looks great on paper.
Yeah. If you're a passive investor scanning a Bloomberg terminal, you see green next to Ghana and think, oh, they've somehow navigated the crisis.
But it's a classic false positive. The author digs into that 2.19% gain and reveals it was driven entirely by, quote, improved visibility on long-term asset licensing.
So just regulatory paperwork.
Exactly. It was a highly specific, localized regulatory development that gave investors a bit of temporary confidence. It acts as a momentary band-aid, but it doesn't change their underlying macroeconomic arithmetic. They're still paying astronomical prices for energy, and their external financing gap is still structurally broken.
Which leads us directly to the mechanism of how these countries actually survive. Here's where it gets really interesting. Because if nations like Egypt, Sri Lanka, and Kenya are bleeding foreign exchange reserves to pay for oil, their traditional move is to bridge that gap by borrowing capital. They tap the global credit markets.
Right.
But the most terrifying part of this strategy note is the breakdown of why that specific financial lifeline is snapping at the worst possible moment.
And to understand the severity of this, we really have to look at the mechanics of the global carry trade.
This is such a crucial concept. Think of the carry trade as a global credit card. For years, massive institutional investors have treated global central banks like a 0% interest credit card.
Exactly.
A hedge fund will borrow hundreds of millions of dollars in a currency with rock-bottom interest rates, usually the Japanese yen or the euro. They take that virtually free money, convert it, and use it to buy high-yielding sovereign debt in emerging markets. This pocket the spread.
It's free money until it isn't.
Right, because that entire architecture requires the funding currencies to remain cheap. So what happens to these emerging markets when the banks funding their debt suddenly jack up the interest rate on that card?
The capital flight is brutal, and it's immediate. The strategy note outlines what it calls the tightening triangle, a coordinated structural shift by three of the world's most important central banks, and this all unfolded over just 8 days. Let's start with the Bank of Japan.
Okay, because on the surface, the BOJ kept their policy rate at 0.75%, which, in a vacuum, still sounds incredibly accommodative.
It does, until you look at the internal mechanics of their meeting. The BOJ sharply revised their core inflation forecast for the 2026 fiscal year from 1.9% all the way up to 2.8%.
Wow.
Yeah. 3 board members actually dissented and voted for an immediate rate hike to 1.0%. And more importantly, the Ministry of Finance physically intervened in the currency markets, buying yen after it blew past 160 to the dollar.
They're actively fighting the depreciation of their currency, and that intervention physically drains liquidity.
Precisely. And the bond market reacted instantly. The Japanese government bond 10-year yield spiked to 2.50%. Just to put that in perspective, at the end of 2024, it was sitting at 1.09%.
That is a tectonic shift in the cost of capital. I mean, if you're a global macro fund using the yen to fund your emerging market debt purchases, your baseline cost just more than doubled.
Right.
So Japan making the yen more expensive is a massive blow, but it wouldn't be fatal if the euro wasn't simultaneously tightening the vice.
Which brings us to point 2 of the triangle, the European Central Bank.
Right.
The ECB held their main rate at 2%, but President Christine Lagarde explicitly signaled a June rate hike. She effectively closed the second escape valve for cheap funding. The 10-year German Bund, which is the bedrock benchmark for European borrowing, broke above 3.1% intraday.
Wow.
That is the highest level we've seen since 2000.
A 15-year high on the Bund. So the yen is getting vastly more expensive. The euro is getting vastly more expensive. All eyes then turn to the Federal Reserve to provide some kind of forward guidance or stability. What is the third point of the triangle doing?
Well, the Fed held rates at 3.63 to 3.75%, but the committee is just paralyzed by indecision. There were 4 dissenting votes at the FOMC meeting. The strategy note highlights that this is the highest number of dissents at a single meeting since 1992.
And the dissents weren't even in the same direction. You had Hammock, Kashkari, and Logan wanting further tightening, while Mirren wanted an immediate cut. The world's most important central bank is publicly disagreeing on the fundamental direction of global macroeconomic risk.
And if we connect this to the bigger picture, that uncertainty is absolute poison for the carry trade.
Yeah.
If you're an institutional portfolio manager, you rely on predictability to leverage those cross-border trades. When the BOJ is intervening, the ECB is hiking to 15-year highs, and the Fed is fracturing internally, the risk-adjusted return of holding frontier market debt just collapses.
Because if the cost of your funding goes up and the volatility of the asset you are buying goes up, the math forces you to unwind the trade. You sell your emerging market bonds and repatriate the capital.
Exactly. And when those massive institutional flows reverse, they drain liquidity out of the emerging markets at the exact moment those nations need to borrow to cover their exploding energy import bills. The structural backstop for the frontier universe has been entirely removed.
It's a devastating confluence of events for the energy importing nations. But okay, let me play devil's advocate here. We've clearly established that the frontier nations are facing a legitimate sovereign debt crisis. But what about the other side of our smoothie? The strawberries. The AI hardware boom in Asia.
The savior of the index.
Right. The entire market is banking on this being an unstoppable supercycle. If Korea and Taiwan keep printing billions, doesn't that fundamentally justify the strength of the EM index, even if the composition is skewed?
That is the consensus Wall Street view, for sure. The note points out that BlackRock, Merrill Lynch, and Goldman Sachs all share a unified thesis. The AI capital expenditure cycle is impenetrable. Goldman is actually projecting AI Capex to hit $1.7 trillion annually by 2031.
$1.7 trillion a year flowing into servers, cooling systems, and microchips. I mean, that kind of capital velocity can sustain a market rally for a very long time.
It can, provided the capital translates into physical output.
Ah.
But the final and perhaps most disruptive revelation in this strategy note comes from a deeply buried JPMorgan data point. JPMorgan tracked the flow of that Capex and noticed that nominal and real information processing investment had begun to diverge significantly since early 2025.
Okay, wait, so what does this all mean? Let's translate that divergence for everyone. Nominal investment is the raw dollar amount moving through the system, and real investment is the actual physical infrastructure you get for that money.
Exactly.
So if they are diverging, it means the entire AI supply chain is being hit by input cost inflation.
Precisely. You are pouring more dollars into the top of the funnel, but the cost of copper, the cost of specialized labor, and the cost of power generation to run these massive data centers, they are all skyrocketing.
Right.
JPMorgan explicitly noted that a larger share of spending is being eaten up by higher input costs. The physical volume of infrastructure being built is no longer keeping pace with the dollars being spent.
The bang for each Capex buck is starting to fade. The AI investment supercycle isn't immune to physics. Just like the railroad boom or the telecom fiber boom, it is finally hitting the brutal reality of physical world constraints.
And this exposes the ultimate structural irony of the current market environment. Think back to that 14.7% return on the EM index.
Yeah.
The single pillar holding up that entire aggregate number, the massive premium assigned to Korea and Taiwan, is built entirely on a Capex cycle that is now demonstrating clear signs of margin compression and input friction.
The consensus has priced the AI boom for absolute infinite perfection. But the raw data on the ground shows the gears are already starting to grind.
Which brings us to the core philosophical takeaway of this entire strategy note. The author channels the legendary investor Howard Marks, who famously observed that the most dangerous thing in investing is the widespread belief that there is no risk.
And you look at the broader landscape, the S&P 500 at record highs, the EM index up double digits, the debt spreads historically tight, and the market is violently signaling a belief that there is no risk.
But that belief requires a complete failure to disaggregate the data. The market is pricing global macroeconomic stability against an average that mashes together Korea's semiconductor monopolies with Brazil's oil windfalls, and it completely ignores Egypt's blown-out subsidy budgets and Sri Lanka's vanishing import cover.
Yeah.
Capital markets are technically still functioning. Gramercy documented $11 billion in hard currency debt issuance just this week, but those markets are only open for the right credits.
The market is quite literally looking at the wrong proxy. I mean, Korea's Carol SPI index jumping 31% in a month is an extraordinary wealth generation event, but it is a strictly Korean event.
Exactly.
It does not provide the capital to pay Ghana's external financing bill. And the fact that global bond yields are compressing as if it does, well, that is a systemic mispricing of risk.
It demands that we completely reevaluate the metrics we trust to tell us the truth about the economy.
And that brings it right back to you listening to this deep dive. You cannot afford to just accept headline numbers at face value anymore. You have to ask what makes up the average. Because if an entire global financial narrative, literally trillions of dollars in capital allocation, can be so heavily distorted by two countries' semiconductor exports masking the sovereign distress of dozens of other nations, well, you really have to ask yourself, what else is hiding in plain sight?
It's a great question.
What other averages in your daily life, whether it's national unemployment figures, average household income statistics, or even the productivity metrics at your own company, are completely obscuring the true reality of the situation? Thank you for joining us on this deep dive. Keep questioning the consensus, and we will catch you next time.